Well, thank you, Esther, and really thank you to the Peterson Institute for hosting today's event. I especially want to thank Assistant Attorney General Kanter for being here today, and to both he and Attorney General Garland for their support of the work to bolster competition in banking and financial services. Recently, there's been growing interest in bank mergers and how regulators and law enforcement are reviewing them. In the past 18 months, we saw some significant transactions abandoned, including the proposed tie-up between State Street and Brown Brothers Harriman, as well as TD Bank's proposed acquisition of First Horizon. There's been ongoing debate about JP Morgan Chase's acquisition of the failed First Republic Bank, as well as news of a proposed merger of two large credit card conglomerates, Capital One and Discover. Today, I will discuss in more detail bank mergers and consolidation. First, I want to offer some observations from the recent review of the bank merger framework initiated after President Biden's executive order on promoting competition in the American economy. I then want to share some noteworthy features of a proposed policy statement approved by the Federal Deposit Insurance Corporation Board of Directors this morning. I'll conclude with some recommendations for further reform, including special considerations for dealing with failed banks. As always, my remarks today represent the views of the CFPB and do not necessarily represent the views of any other component of the Federal Reserve System or any member of the FDIC's Board of Directors. As President George mentioned, banks have gotten much bigger and far more complex in recent decades. America's largest bank, JP Morgan Chase, can trace its lineage to an array of other financial firms, including Dime Bancorp, First Chicago, Bank One, Great Western, H.F. Amundsen, First Commerce, Chemical Banking, Washington Mutual, Bear Stearns, JP Morgan, and Chase Manhattan. Bank of America, our second largest bank, is similarly the combination of U.S. Trust, MBNA, Continental Bank, Security Pacific, Nations Bank, Bank Boston, Bay Bank, Summit Bancorp, UJB Financial, Fleet Bank, Countrywide, Merrill Lynch, and Bank America. Wells Fargo, which has had a number of challenges in recent years, is the amalgamation of First Interstate Bancorp, Norwest, South Trust, Central Fidelity, Core States, First Union, The Money Store, Wachovia, and more. In 1990, the top 10 banks controlled 15% of banking sector assets. Today, they control 53%. This consolidation has eliminated many small and mid-sized relationship banks. The 15,200 banks with less than $100 billion in assets controlled 85% of the market in 1990. Today, the remaining 4,500, under $100 billion, control just 29. This creep of concentration came from two significant spikes over the decades. The 1990s, where there was a deregulatory fever, the bailouts of the 2008 financial crisis. In the 1990s, the Federal Reserve Board, the Department of Justice, and the banking regulators, in my view, seemed to drift further away from the legal mandates to protect competition and resilience in the banking system. They shifted toward something more akin to a European-style national champion policy where bigger was better. The average annual bank mergers per year skyrocketed from 345 in the 1980s to 510 between 1990 and 98, with a similarly dramatic increase in total deal value. The merger wave was largely the result of interstate branching deregulation, as well as the Justice Department's weakening of the bank merger guidelines in 1995. In 1999, Congress enacted the Gramm-Leach-Bliley Act, which tore down many of the structural separations and conflict of interest provisions in banking law, which accelerated consolidation more. A 1999 Gallup poll was particularly interesting to us. In that year, the survey revealed that 43% of consumers reported that their bank had been sold or merged with another in the previous years. By a 3-to-1 margin, individuals reported that customer service got worse rather than better. Twice as many consumers felt rates on credit cards and checking accounts also got worse rather than better. Consolidation in the banking system, of course, jumped again in the aftermath of the financial crisis in 2008. Large firms on the brink of failure merged with others through transactions facilitated by the government. While there were benefits from the stability in the short term promoted by these transactions, there are a number of ongoing questions about how households, small businesses, and the public are bearing the long-term costs of a potentially less competitive, less responsive, and more systemically vulnerable banking system. The agencies have generally shied away from conducting empirical retrospective analyses of these mergers in the banking sector. But third-party analysis, as President George mentioned, suggests that many of the efficiency gains were not necessarily passed through to customers. In fact, the cost of products often increases and quality of services can erode. For example, recent CFPB research shows that larger depository institutions, which include many that have engaged in serial acquisitions, are offering materially higher interest rates on credit card loans compared to their smaller competitors. The largest banks are also offering lower rates on deposit accounts than small banks. And I'll just say as an aside, when we compare those credit card rates, that's also controlled for credit tier of the customer. Mergers can also lead to abandonment of relationships, difficulties with accessing small business credit, and more. And this is in addition to other costs the public faces with implicit subsidies to the largest firms. In July of 2021, President Biden signed an executive order on promoting competition in the American economy. The order established a new competition council that myself and the Attorney General, Assistant AG Kanter serve on, that brings together cabinet departments and regulatory agencies to help revitalize competition across sectors of the economy. At the time of the executive order signing, I served as a commissioner on the Federal Trade Commission and played an active role in working with agencies across the government on competition policy. The executive order urged many agencies to consider updating policies and putting into place new rules. For example, it called on the CFPB to propose rules under a dormant legal authority to make it easier to switch financial products with less friction. Importantly, for our discussion today, it called on the Attorney General to review the Department of Justice's protocols with respect to bank merger review, including the infamously outdated Bank Merger Competitive Review Guidelines from 1995. In 2021, the FDIC Board of Directors voted to solicit comment on the Bank Merger Act review framework. Assistant AG Kanter also announced that the Department of Justice's Antitrust Division would be working to, quote, ensure that the banking guidelines reflect current economic realities and empirical learning, ensure Americans have choices among financial institutions, and guard against the accumulation of market power, end quote. Alongside agency staff, I also personally conducted an analysis of existing processes and a range of past approval orders to compare them with those used and issued in merger review in other sectors of the economy. This analysis also included examining some of the protocols and orders of the Office of the Comptroller of the Currency and the Federal Reserve Board of Governors. Now, by way of background, the Bank Merger Act requires affirmative approval of the acquiring bank's primary federal banking agency. And like with mergers in other sectors, such as telecommunications, transportation, and energy, agencies use a multi-factor analysis. The Bank Merger Act has 3 factors I want to touch on today. First, competition. Agencies are forbidden from approving a proposed merger that would result in substantial anti-competitive effects. The Attorney General and Assistant Attorney General retain their jurisdiction to prosecute illegal mergers and anti-competitive conduct under the Sherman Act, Clayton Act, and other appropriate statutes. The Assistant Attorney General also plays a key consultative role in the consideration of this factor through the transmission of a report to the relevant banking agencies. The second is community. Agencies are required to consider the effect on the, quote, convenience and needs of the community to be served, end quote. Given the special public benefits accorded to insured banks, agencies must closely analyze the impact on the community. This factor is a common statutory consideration for banking applications, for example, in chartering and deposit insurance. Third, financial stability. Agencies must consider the risks to the stability of the U.S. banking and financial system. This factor was added in 2010 by Congress to address concerns regarding the bailouts of too-big-to-fail firms that had grown through merger sprees. Other factors, such as the institution's ability to combat money laundering and the institution's financial and managerial resources, are also statutory considerations. Importantly, an application can be denied based on an unfavorable determination on any of these factors. Here are some of the most salient takeaways I derived from the retrospective review of the framework. First, there were significant deficiencies in the analysis of competitive effects of a proposed merger. Both the Justice Department and the banking agencies had used analytical methods that did not appear grounded in modern market reality of banking, such as the heavy reliance on local market share of deposits as the primary or even sole criterion for assessing competition. Even when the agencies look beyond local deposit markets, one is hard-pressed to find proof of the analyses in guidance and orders. Second, there were material gaps between the information requested in Bank Merger Act applications and the materials required for submission under the pre-merger notification regime. The Hart-Scott-Rodino Act requires firms engaged in mergers to notify the Federal Trade Commission and the Department of Justice by making a filing that provides important details about proposed transactions. Banks are exempt from this requirement if the transaction requires approval under the relevant bank merger statutes, which have their own application form. Now, in the review, we identified many places where items requested in the Hart-Scott-Rodino filing were not even touched on in the Bank Merger Act application. For example, the Hart-Scott-Rodino notification requires production of documents related to the deliberations by officers and directors. In my experience, these documents are critical to understand deal rationale and may reveal anti-competitive intent. Indeed, we have seen in consumer finance how financial firms can pursue catch-and-kill mergers to eliminate competitive threats from upstarts. However, banking agencies do not specifically or comprehensively require this information. Third, the banking agencies do not provide transparency on the reasons for non-approval. Rather than deny mergers and publish orders describing the rationale for denial, there has been an informal understanding between the regulators and the industry that applicants will be allowed to withdraw their application instead of receiving a denial. Under many, if not most circumstances, this has struck me as somewhat inappropriate. But even in cases of withdrawal, the banking agencies do not provide any public communication about the rationale for non-approvals, depriving the public and market participants of any guidance or transparency. Fourth, the federal banking agencies analyze the community factor in ways that are unmoored from the law. More specifically, The regulators typically look to compliance with the Community Reinvestment Act, which suffers from severe grade inflation where nearly everyone passes. It was also passed after the Bank Merger Act. And there are also issues with community benefits agreements that are entered into with community organizations, but community organizations have little power to properly enforce them because they are not codified in the approval order. Fifth, there's just basically no insight into how the agencies are implementing the 2010 amendments, which specifically require a consideration of risks to financial stability. For example, the Federal Reserve Board of Governors order approving Silicon Valley Bank's acquisition of Boston Private doesn't provide much information about how the agencies considered the factor. Of course, in retrospect, we know, as the Federal Reserve's own retrospective showed, Silicon Valley Bank's speedy growth proved to be a disaster, and its failure necessitated extraordinary government support. Sixth, I was persuaded by the views of various stakeholders that the distinct institutional incentives of banking agencies have affected their approach to merger review, at least in the past. For example, the issue of charter flipping, whereby regulators sought to attract a bank charter and the associated fees, may lead to a race to the bottom. In addition, other agency responsibilities, such as the conduct of monetary policy, may be a higher priority in some cases, or otherwise be in tension with requirements to carefully assess all the factors. Seventh, the application review process is really long. Specifically, during the process, applicants are asked for information and data that could have easily been requested in the initial application form. Long-standing Department of Justice protocols sometimes included an analysis of potential fixes to a merger through highly unusual letter agreements with merging parties, even when the banking agencies have not completed all of their assessment of the statutory factors. Indeed, a quick denial may be better for the agencies, the acquiring bank, and the target bank compared to an interminable bureaucratic journey. Finally, the banking agencies rely on remedial provisions and conditions that fail to remedy harm. For example, when ordering divestitures, agencies have frequently permitted merging parties to divest assets many, many months after the transaction's closing. This gives plenty of time for the merging parties to sabotage their future competitor. The FDIC's proposed Bank Merger Act policy statement would bring more rigor to the merger review process and better align the agency's framework to the actual law Congress passed. I'll highlight some key elements of the proposal, focusing on three of the factors. First, it makes clear that the agency's competitive effects analysis will go beyond the traditional focus on local deposit markets to dig deeper into the deal rationale and market dynamics. A narrow analysis of deposit market shares in local communities can miss many dimensions of competition across geographies, product markets, customer segments, cluster markets, and more. For example, a merger between two banks that are major commercial lenders to mid-sized businesses in a regional economy could substantially lower competition. Similarly, a merger between banks that compete nationally in a concentrated consumer credit market could also lessen competition. Both transactions will look relatively harmless at the local deposit market level. And more importantly, it's unlikely that these or other harms can be remedied through cookie-cutter orders requiring branch divestitures. The policy statement embraces a much more comprehensive and empirical view of competition. The agency will look at potential impacts on competition locally, regionally, nationally. It will look at relevant product markets beyond deposits, analyze the impact of the transaction in different customer segments with an eye toward ensuring customers whether they be consumers, small businesses, mid-sized businesses, whomever, retain meaningful choice in relevant markets. The analysis will also be bolstered by revisions to the FDIC's supplement to the Interagency Bank Merger Act application form. Notably, the agency will require production of other analyses that were completed for the bank's directors and officers, either internally or by third-party investment bankers or consultants. The Department of Justice and the Federal Trade Commission are also proposing additional changes to the Hart-Scott-Rodino Act reform that may prove to be valuable to the banking agencies as well. The policy statement moves away from the more permissive approach to post-closing divestiture remedies. When mergers are conditioned by divestitures, there'll be significant attention to ensure that buyers of assets can actually replace the competition lost by the transaction. For example, as the FDIC required in the merger of Umpqua and Columbia, two very important banks operating the Pacific Northwest of the United States, the merged firm first divested branches to smaller banks and was prohibited from enforcing non-compete agreements against key employees in those divested businesses. Second, the policy statement restores the robust public interest review that Congress intended when requiring consideration on the convenience and needs of the community to be served. U.S. law has long treated banks as essential infrastructure and has incorporated many aspects of public utility oversight. The convenience and needs language itself stems from the, quote, public convenience and necessity test associated with telecommunications, energy, and other utility frameworks dating back to at least the 1800s. As a result, banks' ability to merge must be directly tied to the interest of communities they serve. Over time, the agencies generally used banks' Community Reinvestment Act rating, which is assessed individually on past performance. The policy statement makes clear that the test is a forward-looking analysis as to whether the combined bank will better serve the market than individual banks did prior to the merger. That means consultant-drafted puffery regarding how savings will shift to families and businesses won't suffice. Applicants will need to provide specific and forward-looking data as to how the community will be better off. As part of the review, the agency will evaluate branch closures for at least a 3-year window. Any material negative impact on consumers' access, particularly in low and moderate income communities, is generally going to be inconsistent with satisfying this factor. The agency is going to carefully evaluate the bank's compliance records, especially with respect to consumer law. The FDIC will consult with the relevant state and federal authorities like the CFPB. Repeat offenders of consumer protection and fair dealing laws will face a steep uphill climb to satisfy this factor. If banks make certain forward-looking projections or representations to the agency in the application, the policy statement makes clear the agency may make those representations part of an order to ensure they are actually complied with. The policy statement also makes clear there's a high bar for any positive finding on the convenience and needs factor to overcome an adverse finding on the competitive effects factor. Finally, the FDIC is proposing to add a section to the policy that describes the agency's financial stability analysis. The statement, for the first time, describes how a transaction would be evaluated to determine if it materially increases risks to financial stability. There will be a careful review of the bank's combined size, interconnectedness, complexity, cross-border activities, resolvability, and critical services provided. Significant transactions involving or resulting in a bank with $100 billion or more in assets, the threshold we understand to be a domestic, systemically important bank, will receive heightened scrutiny. 36 of the 4,500 banks in the U.S. are above this threshold. By codifying this, boards of directors and management and law firms at large firms can understand that the likelihood of approval of mega mergers may be low. As we saw with Silicon Valley Bank's failure, the agency will also evaluate potential for contagion. I also want to note the policy statement's discussion of the combined bank's current regulatory framework, or the fact that it will grow into a more stringent tier of oversight, does not automatically mean that financial stability concerns are ameliorated. That would simply write those words out of the 2010 amendments. I'm looking forward to the ongoing input on this statement, as well as the merger review process. Now, of course, there are other areas where we would benefit from additional thinking and reform. First, given the unique role federally insured depository institutions play in the economy, I think Congress and the regulators should consider broader adoption and consideration of growth and size restrictions. There's a strong case to be made that given the critical role that entrepreneurs and small businesses play in the U.S. economy and the vast geography of our nation with urban, suburban, rural, and more, the U.S. benefits more from having a large number of small and mid-sized banks rather than a market structure with just a handful of very large banks like we see in Europe and China. Existing law already includes a number of statutory caps, and it may be worthwhile to see whether to strengthen them. Second, we should fix the failing bank exemption to existing merger prohibitions. For example, under ordinary circumstances, JP Morgan Chase, which is above the cap, would be ineligible to acquire First Republic Bank, absent this exception. It makes little sense to allow such an acquisition unless there are no other willing bidders or no other means of executing an orderly wind down. Third, we must address the chaos that consumers can face through a merger. Over the years, we've observed significant consumer challenges, such as the inability to access funds or key account information after a merger or acquisition. I've also observed that consumer law violations often have their roots in botched merger integrations, particularly when it comes to IT systems. Finally, to level the playing field, we should continue to reduce the too big to fail subsidy. Banking organizations that are already large want to grow even bigger to enjoy these subsidies, such as the perception, which we saw very clearly last March in the failures, that the largest banks offer free, unlimited deposit insurance. There are many ways under existing law to reduce these subsidies to ease the pressure to consolidate. Congressional action to expand deposit insurance coverage would also help community banks and mid-sized banks that are not perceived as too big to fail. Modernizing our merger review framework is an important step, though it will do little to undo some of the harms from the more pro-merger policy posture of the past. I just think banking is so essential to the functioning of our economy and our society, and we have to make sure that our banking system is always dynamic, fair, and competitive. Thank you very much.
Before we get into some of that, I want to turn to you, Jonathan, and just maybe paint a broader picture here in terms of the importance of competitive markets, the role of the Department of Justice to protect competition as being core to our democracy. I've heard you say that some other speeches, in the context of bank mergers, and I realize we had breaking news today on another front around competition here, but if we think about it in the bank merger context, which Rohit just covered, what important shifts do you see that are required here, either in broad terms or anything that he mentioned?
Yeah, well, thank you for having me. Thank you to Peterson Institute, and thank you to Director Chopra for joining today in this extraordinarily interesting conversation. So I have talked about how antitrust and competition and democracy go hand in hand, because concentration of power leads to lack of opportunity, lack of upward mobility in our society, control over views and ideas. And so the antitrust laws were created because this is a core value of our country that animates our desire for liberty, or animates our desire for really what I like to think about as, and what we all talk about as, the American dream. Bank mergers play a very important role in the history of antitrust enforcement. So if you go back to one of the most important merger cases in all of antitrust law, it involves it's called Philadelphia National Bank. And so in many respects, the single most important merger case is one that involved banks. And it talks about why we care about bank merger competition. And it explains that competition among banks leads to competition and a vibrant economy in all corners of the country, in all corners of business, in all corners of commerce. And so really fighting for competition in banks is the equivalent of fighting for competition in everything.
Yeah, thank you. So I was impressed at the litany you went through of the mergers that led to the building up of certain big ones. We might have a test on that later to see if we can repeat that. But there is a merger that's being discussed today, and I know you're not likely to want to jump in on that specifically, but it's Cap One and Discover. And I hear two approaches to how just general thinking around this topic goes, which is, do you need to combine these things as a way to compete with some of these very large players, whether it's Visa, MasterCard, American Express, or does it raise anti-competitive issues in a different sense? And so I'd be interested, just as you've described this framework today, are there general ways we might think about when can these things be pro-competitive as opposed to creating competition issues?
It's a good question. I'm going to be careful given the context of the question, but here are some of the questions one might look at and think about. For example, the credit card market, we have seen where a small set of players really dominate the market. And when we look backward, we see that there's a big delta between the large issuers and smaller issuers in terms of the rates and fees that they charge. So that suggests that some of the past mergers in the credit card industry didn't necessarily translate into benefits. We often hear in the context of vertical mergers about the benefits that will occur from creating scale of a new network to clash with the others. The question that a rigorous analysis would always ask is, do you need the merger to do that? Or do you simply need to create or shift business to one of those competitors to create that scale? Alternatives to the control is a key part of the analysis. I think, Esther, you raised something that also hits quite carefully on the blindsidedness of focusing on local deposits. You know, you do have credit card banks, mortgage banks, other who may raise funds through deposits. And that may have nothing to do with the competitive intensity they're providing in a specific product market. And I would even say that we're going to be looking at product markets, not just at a big picture small business, credit card, auto. We would even look at it within certain tiers. We know that, for example, the credit card market has cashback cards, rewards cards, miles cards, subprime cards, no annual fee cards. There's lots of different ways in which there are competitive intensity is exhibited. So the key here is actually to analyze the information and approach it not with a cheerleader spirit, but with a dry and sober look at what is in the law. And I think that's very important as we approach this. I want to share also that I think the way you can speed up these reviews is to ask for the information up front. And I think that will also help to ensure that a target does not decay forever in the case of a denial.
So can we talk just a little bit more about this deposit issue? So the Herfindahl-Hirschman Index, I used to be an applications analyst, and the HHI was always coming up as part of that discussion. But of course, as the world changed with boundaries of geographies getting bigger, a lot of questions about how that would apply. Do you, Jonathan, see that changing in any respects, or how does that reconcile with Rohit's comment on deposit?
Yeah, so let's take a step backwards and think about where we were in 1995 when the current bank merger guidelines were written. I'm no spring chicken. You can tell from my hairline. I was still in college in 1995. People were still waiting online on Friday to withdraw cash for the week. The signing up at a bank might get you a free toaster. I think the world's moved on a little bit since then, and the role that banks play are not only different, but they're multidimensional, and it really depends on what it is you're consuming. And so the needs of a local family farm might be different than the needs of someone working in Manhattan. Might be different than the needs of a startup in California or in Austin, Texas. The needs of bank customers are as varied as the products and services and clusters of products and services that banks themselves provide. And so we would be doing ourselves a disservice, and we would be doing the public a disservice if we simply limited our analysis to a paint-by-numbers approach that looks at bank deposits in geographic branch overlaps. I think there's widespread recognition that that mode of analysis is outdated. This is something I've talked about a lot publicly, but it's something that many others, including other bank regulators, have talked about. And so we need to take a step back and ask ourselves, how does competition work in this market? If two banks are merging, what are the different services and areas where they compete? And will the transaction threaten to harm that competition or lessen it in a way that's substantial? And that's a flexible approach, one that in our enforcing the Clayton Act we've articulated, I think, in a pretty forward-looking and important way in our broader merger guidelines that talk about every industry and cite to cases like Philadelphia National Bank in suggesting that when we examine bank mergers or any merger for that matter, we need to start with that foundational question. How does competition here work, and will this transaction affect it? And I think as we think about review of bank mergers in a modern economy, we need to start with that question as well.
Yeah, I'll just add that the HHI that you reference is kind of one empirical technique that's not the be-all and end-all. And certainly in a transaction, each relevant market within that larger transaction can involve multiple measures by product, market, and segment. I think I'd say that the 1995 guidelines basically feel biased against community banks who will quickly trip the threshold. And for a large player swooping in to a new geography, it doesn't. I don't know why we would continue that. And for what it's worth, my own observation is that those guidelines have been somewhat inoperable anyway, and that there has been a sense of we have to be enforcing the law as written and not creating artificial safe harbors. So the assistant AG mentioned these broader merger guidelines that are cross-sectoral. I think they're going to prove to be very influential, even in bank merger reviews.
Yeah, and I will point out for those broader merger guidelines, we address, along with our colleagues at the Federal Trade Commission, we spent 2 years developing these guidelines and reviewed tens of thousands of comments from people across all industry. And what we say is, yeah, there are some instances where you might actually have a horizontal local competition in a small geographic area. And there are even references to HHIs, but we don't stop there. We talk about platform markets, we talk about network effects, we talk about foreclosure, we talk about conflicts of interest, where an acquisition might lead to a conflict of interest that might result in harm to folks on all sides of a market. We talk about countervailing factors that merging parties might put forward to justify their transaction. And then we talk about some of the defenses, like the failing firm defense, which alludes to something Director Chopra mentioned during his remarks, that in order for the failing firm defense to apply as a matter of law, you need to demonstrate that there is no less anti-competitive alternative purchaser. And so some of these concepts are spelled out in substantial detail in a very rigorous and realistic way. And I think it does provide a lot of insight into how we should think about mergers generally across all segments of the economy.
Interesting. So the issue of no paint by number comment makes sense to me. You often hear from bankers in particular, what are the rules? How will we know ahead of time? And I'm curious, something you said in your remarks, is there more learning to be done through agencies acting, even when it is to say no to a transaction? How much clarity, given that each case is different, can be provided? So how, as you've talked to the banking agencies and others, will this align relative to, one of the things we often hear is banks want to know, just tell me tell me how this is going to work. And what you've described here is there are going to be situations and context around some of these mergers. Is that a concern? Is that
well, I think what you want to do is you want to be able to look at what the status quo is, which is completely draped in mystery about how the agencies will look at the application. And instead, before proposing it, get a little bit more insight as to what will be asked. It's why I think the changes to the application are important. It's why I think the analysis we've described is important. They can then go in knowing this is what we're going to ask. Let's prepare it now. Let's do our own due diligence on it. It's never going to have a checklist. Unfortunately, the US economy is too dynamic to be able to boil it down into a checklist. But I think this really goes a very long way to do it. But I do think it's a disservice when the Justice Department challenges a merger. They file a complaint in federal court. I don't want to see the agencies just sit on an application forever with the hopes that it just abandons. Sometimes they need to stand by, publish their analysis so that it can stand up to some public scrutiny.
Yeah, I would say that I'm not a bank regulator. The Department of Justice is not a bank regulatory agency. It's a law enforcement authority. And we enforce the laws, and my role as the head of the Antitrust Division is to enforce the antitrust laws and competition laws as written by Congress. And we review thousands of mergers a year. And we review the mergers under the Clayton Act, which is a statute that has broad application. and we use it, and we apply our merger guidelines to provide transparency in our process. But we're familiar and comfortable with a process where we start by asking, how does competition here work? What are the realistic effects on competition? And then moving forward. And we have companies across all industries that have that come in, they can prepare for the review, they know the kinds of questions we're going to ask, they know the kinds of cases that exist in terms of how to apply the law, and then we have a conversation and an investigation to determine whether we need to take action. And in the vast majority of instances, we don't. In significant but a small number of cases, we do. And then, as Director Chopra mentioned, we go to court. So the flexible framework, the one that starts from what are the market realities here, is something we're familiar with. It's something that we're comfortable with, and it's something that we apply to industries across the entire economy. And it provides transparency. We have thresholds. We have presumptions, but we also give the merging parties the opportunity to make arguments about market realities, and we have the ability to work backwards from what's really going on in the marketplace. That strikes me as a more sensible approach to thinking about merger analysis, generally speaking, than something that, again, is overly rigid or overly paint by numbers.
Yeah. So I wondered if you'd speculate a little bit with me of thinking about these changes, some of these modifications to the guidelines, and looking ahead a decade. So you described in your remarks, Rohit, how the industry had changed. We still have a lot of small banks. We have large ones. What's happening in the middle, I think, is a question in terms of regional size banks. And I often hear people challenge, we have too many banks in the United States. As you look at the landscape, what does good look like in the next decade? Is it more consolidation with competition among those fewer players? Does the middle get squeezed out? Is there anything about the landscape that you would hope to see as a result of thinking differently about some of these bank mergers?
Yeah, I really worry that we've been lurching toward a European or Chinese market structure here. I think that there has been a sense of let's go there because we can create all these efficiencies and therefore, ta-da, everything
and maybe
is
more stability even.
Yeah, and I think that really presupposes a national champions architecture whereby there is implicit backing of the sovereign for their solvency, when in reality, our country has chosen to ensure deposits and to ensure the safety and soundness of the whole system. When I look at the Paycheck Protection Program and other pandemic-related assistance, we have seen that the more deconcentrated a region was, they were able to obtain PPP loans more effectively. We saw some of this in other sectors too, such as pharmacies, where there was not just a dominance by chain pharmacies. When there was lots of local pharmacists, they were able to respond a little bit more quickly. In some ways, we all understand economies of scale in lowering unit costs. I don't know if we've appropriately weighed the impact on resilience, whereby when one bank gets in trouble, we literally had to hit a panic button to stop it from a contagion. So I like the idea of heterogeneous market structure that includes ability for small and mid-size to be able to succeed without an unfair competitive advantage to the larger ones. I think the Federal Reserve, in its history, used to provide a lot of infrastructure, payments clearing, check clear, all sorts of things to make sure that local banks really had the ability to kind of fairly compete. So I like the idea of there being a lot of heterogeneity in it and not a kind of consolidation creep where there's just a feeling of an endless. I also would say, Esther, that, and it's particularly relevant given the lawsuit filed by the Assistant AG today, how we reconcile the role of big tech companies in the banking system. At issue has been their role in taking deposits, in moving payments. The Justice Department today alleges monopolization by Apple with respect to a number of its practices, including Apple Pay, which has been a subject of very significant concern from regulators around the world, banks here, the junk fees that lead from that structure. So I don't want us to replicate what we see in China, where has an extraordinary influence of big tech firms in banking and payments. And I think that it raises a whole host of issues. So both looking at our chartered banks and credit unions, as well as the forces of other large conglomerates, particularly in the tech space, to get their hands into banking, to me, those are big ticket questions.
And I wonder if you'd build on that, Jonathan, talking about the tradition of separation of banking and commerce. So as we've seen around the globe, and I'd be interested in observations that you have about what other countries are doing in this regard, questions about opening up your payment infrastructure to these players, and where these lines begin to blur around that. Do you bring competition in from the non-bank sector? How have you seen this playing out? I used to get asked a lot of questions about the UK as they tried to insert competition to their structure of bringing in other players to the payment system, for example.
So we start from the premise that at the Justice Department that we're a law enforcement agency, and the values of the laws we enforce are written by Congress. Congress started in 1890 with the value that competition is foundational to a thriving economy and to a country that values democracy and liberty. That value system has been upheld through the creation of the Clayton Act and then amended many times over many years, including the Seller-Kefauver Act and the HSR Act and numerous others, the Bank Merger Act. So we start from the premise that competition is the value that Congress set forth. And it did so because it believed that competition was central to our way of life. So we enforce the law, and then we look in each situation to understand how competition works. I think we are not a bank regulator in the sense that we're comparing the models of other jurisdictions and trying to figure out which one is right and which one is wrong. That decision has already been made, at least from my perspective, by Congress, which has decided that we value a system of competition. Now, competition is itself a complex, often, and important multidimensional concept. And so competition can play out, again, among entities that are direct competitors. Competition can play out in multi-sided markets, in platform markets, in transaction markets. And we need to start with the question is, well, how does it work? And so conflicts of interest is something that I've talked about quite a bit in various different industries. And if there are conflicts of interest that are created, for example, by a merger, we look at that very carefully to try to understand whether that conflict of interest will harm competition across the entire market. And so those are foundational principles that we bring to every merger that we review in any industry.
And Esther, maybe I'll just, by commenting on the international comparisons, I think it's good for us to really admire the US system that we did create in banking. Just like the electricity and the telecommunications, I really think banking is just like that essential infrastructure. And we basically, as a society, have figured out if we pool our savings and deposits we can transform that into opportunities for lending. But it only works because we have confidence that our deposits are always going to be there. And that's why we have a system of federal deposit insurance, Federal Reserve discount window, all the other privileges that we say these are just for banks. And in exchange for that, we say you must be responsive to your local community. You must combat money laundering because of the important role that that plays in crime and our national security. We make sure that there's safe and sound practices because it is so critical and because contagion happens so quickly. And the more we see us giving the privileges of to non-banks without any of the responsibilities, I think that's just a recipe for regulatory arbitrage. And I think you see this in so many dimensions. Every company now wants what's called a master account at the Fed. That's for banks. And that's for other firms who are in that kind of regulatory perimeter. We see on the payment system, the CFPB did an analysis, tens of billions of dollars stored in these payment apps. That's not in a bank. Could there be a run that fails and people are out of their money? We have prohibitions in our country against the acceptance of deposits outside of banks, which I think has been sort of whittled away over time, and that has some real implications for the flow of deposits from banks to the shadow banking system. So I think that we need to look carefully at what do we want to preserve. Now, I will say, as I have proposed some rules regarding open banking, the ability for consumers to more seamlessly switch their accounts, obtain better rates, stay away from junk fees, get better service. We have looked quite a bit at how the United Kingdom, the European Union, others have put that together because we want digitization to benefit everybody and ways that give consumers a little bit more power to vote with their feet.
Good point. I want to make sure that we give all of you a chance to raise some questions. So let me turn. There's a microphone back here, and I think Jessica has a microphone. If you would please state your name and your organization. Ask your question, please.
Hi, I'm Lucas Renifo-Keller of the Peterson Institute. In a previous life, I worked as an antitrust consultant, so I'm naturally gravitate towards this. Jonathan, I have a question for you. Since you said that a general principle is competition, or should be competition, sort of along those lines, would you be in favor of something like changing merger guidelines so that people who are proposing a merger have to show that it won't cause harm rather than, the reverse, the people, the plaintiffs having to prove that, right? The government or the DOJ having to prove
Well, the question has already been answered, actually, by the Supreme Court in Philadelphia National Bank, which says that if there's a certain degree of concentration, there is a presumption of harm. And that presumption is a rebuttable presumption that the merging banks or any other entity, and if it's in another industry, can try to rebut by demonstrating that the benefits outweigh the harm. But we actually have a system that works that way, and we've encapsulated that in our merger guidelines that we wrote alongside our colleagues at the FTC. And I do think that is the most up-to-date, accurate, and comprehensive statement for how we think about merger policy.
Thank you.
Carol Wayman, Senator Catherine Cortez Masto speaking for myself. My question, Director Chopra, thank you for a really very thoughtful speech. And I wondered if you could expand on the community criteria and link that to your thought about forward-looking, because we have a lot of communities that are unbanked. In Nevada, we have the highest percentage of people who are unbanked. a lot of folks in tribal communities who don't have banking access. So can you just talk a little bit more about how that community criteria would look in a merger?
Yeah, so the most important thing when we look at banking consolidation across the board, I have real worries that when a large bank buys a smaller one, we see some specific types of lending shift from relationship lending to algorithmic lending. The ability to underwrite a poultry loan, the ability to underwrite some very specific products that are key to that local community. We need to be able to see that under the test for convenience and needs, that actually it's not just, is this large player have a good CRA rating and is the target have a good one? What are you going to do in your business model? Are you going to simply change it to a branch that has no one you can talk to on any type of loan? You just go into the branch and they give you the 800 number. Are they going to discontinue the key types of products? And I really worry that we have a system that basically looks favorably on that. And I think what this policy statement that we voted on this morning says is you have to look at the improvements. It can't just be that you weren't bad in the past. The service to the community must be better than it was prior. And honestly, I think you'll also see a big difference. The policy statement still permits and encourages public input for large transactions, public hearings, the ability for community organizations to weigh in, but it shifts away from the banking regulators outsourcing their legal requirement to community organizations. And community organizations should have more confidence that the commitments being made have some real teeth to them and is not just utter fakery. And we saw a number of community organizations ask some real big questions. After the failure of Silicon Valley Bank, they had codified some commitments around their service to low and moderate income neighborhoods. Once they failed and they were purchased, poof. And I think that is really, these are some of the tough issues that we're going to be dealing with. And I think I really want a lot of our community organizations to comment on this to figure out how we can make some of this merger review actually lead to improvements rather than what I see as a hollowing out of a lot of service to low and moderate income people.
I can build on that because one of the privileges I've had in my role is the opportunity to travel around the country and meet with different stakeholders who are directly affected by corporate concentration. And I spent a lot of time with farmers, family farmers in rural communities. And when you meet with those farmers, they talk a lot, of course, as you might expect, about concentration in the agriculture industry or the right to repair their tractors or various different issues that they confront on a daily basis. But when you sit down with those family farmers, they talk about the hollowing out of their community. They talk about the loss of the local bookstore and the local pharmacist, but they also talk about local banks. They talk about how they grew up with their parents who used to walk into the bank and know the banker, and when they needed loans or they needed services from their bank, it was part of the community, like the fire station or the schoolhouse or the local doctor or hospital or the local pharmacist. And they're lamenting in very real terms, in human terms, how today they don't have that relationship where they walk in and somebody knows who they are, they know what their business is, they know what their business needs are, they know why it matters that the farm gets the loan so that they can stay in business, so that the bank can invest in the community, not just by sponsoring Little League teams, which is important, but by investing in the businesses that actually operate in that community and have done so for generations. And I think it's really important as we think about concentration in all industries, including banking, that we think about those real world impacts and the real world effects on local communities, including and especially rural and farming communities.
Thanks, Director, for coming, and Assistant Attorney General and Esther. Aaron Kofsky with Senator J.D. Vance. Want to be clear, this is on behalf of myself as well. Thanks, Carol. So, I'm going to combine a couple different points you mentioned to raise a question I think that you might have an interesting outlook on. So, I couldn't agree more about the points of small banks, offering different services to communities. If you look at, banks under 250 bill, give out the majority of small business loans, single-family mortgages, right, are really the backbone of society, right? But something you mentioned, which I think is really fascinating, is kind of the implicit and inherent benefits we give to banks, right? From master accounts, which I think is funny in the context of like crypto companies like Reserve Trust getting granted master accounts over the past couple of years. But looking at the discount window, right, and Fed funding costs, right, themselves, because I think GSIB subsidies are a really important discussion point. But it's not just the subsidies, right? It's a lower cost of capital, it's a lower cost of funding, right? So bank cost differentials, right? You see a big bank get much cheaper funding from the Fed, right? Now on top of looking at the subsidies, and I think this is a big part of what's led to the consolidation in the market, right? Especially among the regional banks. Do you think that the Fed should address kind of those differentials and funding costs to better level the playing field for the small guys?
Yeah, so a couple of observations on this. Naturally, there will be differences in funding costs, cost of equity, cost of debt, based on certain legitimate things like business model, geography, all sorts of factors. Those are market-driven funding issues. I worry about the distortion of artificially low funding costs for the too big to fail ones, because that then just creates the concentration creep where everyone else wants that too. And one objection to, we have people who are opposed to the tenets of the Bank Merger Act, which is an old statute. They say, well, you've allowed all these strings of mergers in the past, now are you just going to protect the large ones? And the answer is, the antidote to that is not to create Europe in the United States or China in the United States. It's to address that unfair advantage. And we have many tools in which we should do that to ensure that that doesn't exist. I'll add that we have typically used bank mergers as a core part of bank resolutions. We sell banks to bigger ones. I'm not saying that isn't going to continue to be part of the playbook, but you have seen in certain instances giving more ability for smaller mid-sized players to purchase. And I referenced, I think, the carve-out in the Regal-Neal Act, where people can buy a failed bank, and they might already be advantaged by their lower cost of funds to get even bigger. So I just don't want to see it be a race to the bottom. We want a level playing field where different sizes can compete within different markets. And I think that really is the key. And I hope we all reflect that the more we don't act, we are essentially endorsing the policy of killing off all of the smaller and mid-sized ones and have a handful left. And I think the experience of a year ago this month, you had small, mid-sized businesses, startups, in their top 20 list of their business failing, their bank failing was not on the bucket list. Those folks were basically told, you get free deposit insurance at the big Wall Street banks or a money market fund, and you're at risk with your local bank. That to me is just fundamentally unfair, and I do think why we got to look at expanding deposit insurance, because the largest ones shouldn't be getting it for free.
We have time for one more question,
There's one right there.
right here.
Thank you all so much for being here. My name is Shahid. I work at the American Economic Liberties Project. My question is about really something that we touched on briefly. It's around the merge to compete argument. This is something we've seen more and more recently, and I know it's something that played out recently in Spirit JetBlue, but I'm just curious about, this seems to be an argument that understands the high concentration in an industry, and a firm might use that to ask regulators to approve a merger instead of use that to deny it. And I'm very curious about how you both view those arguments, specifically as they relate to banking. Thank you.
Yeah, I think this picks up on something that Director Chopra mentioned, but the remedy for lack of competition in a market isn't less competition in the market. And I think that's an argument we hear quite often. But if the goal and the value judgment is we want more competition, then the best way to get that is to have more competition, not less.
Yeah, I'll just share that this is not, you see this across sectors, concentrated sectors. I call it the 3 is better than 4 argument, where you have 2 big players and you want someone to challenge those 2. I don't have many examples of this ever really working. And so I get the talking point. I don't see the empirics of it. And I think that that is something that we should constantly be reflecting upon. I'll also add, we often hear the purported benefits, but they're not linked to actually the merger. They're just linked to a change in business strategy. So you can start using a different distributor, you can start using someone else downstream or upstream without owning them. We had for many years these vertical merger guidelines from the 1980s that the Justice Department and the FTC never rescinded, but just quietly told everyone they don't use, which was weird. We finally rescinded them and replaced them over time with what the Assistant AG has mentioned about this cross-sectoral look at the ways in which competition can be lessened. I see a lot of different ways in consumer finance where small number of players, it becomes very easy for them to coordinate. We've seen some evidence of that in the credit card industry, some other places. In banking, since you asked, it's not that long ago since we had the LIBOR scandal, which was essentially a cartel price-fixing scandal that led to overcharging on people's student loans, on credit cards, on so much that I think the United States is rightfully skeptical when there's a small clique of companies that control things.
One thing I will add on that, though, is it does also increase the importance of holding monopolists accountable when they break the law. And so the ability of smaller firms to compete depends on enough oxygen in the market so that everybody has the opportunity to breathe. And if we are not enforcing, at least in our world, Section 2 of the Sherman Act, which holds companies accountable for monopolization and attempted monopolization and conspiracy to monopolize, then we are not fulfilling the will of Congress, and we also are not protecting competition in all its forms.
Well, this has been a fascinating discussion. I could go on all afternoon, but thank you, Director Chopra. Thank you, Assistant Attorney General Kanter, for this really interesting and very timely program. Thank you.
Thank you so much.